CGS-CIMB is a leading integrated financial service provider in Asia. Through our network of local offices in Malaysia, Indonesia, Singapore, Thailand, branches and strategic partners, we have a global presence in over 20 countries, providing a truly Asian perspective. Our businesses include retail broking, institutional equities, derivatives, prime services, equities research, wealth management, and online broking. We also offer a range of Islamic services such as Islamic stockbroking window, Islamic cross-border trading, Islamic securities selling and buying negotiated transaction. Backed by an award-winning research team, we have one of the most comprehensive research coverage of over 800 stocks in the region. Our strong research capabilities form the backbone of our product and service offerings, connecting clients to opportunities. CGS-CIMB, your financial gateway to Asia.
Welcome to CGS-CIMB, Asia's financial gateway. Here's how you can place an order with us. To open the order pad, tap on the menu button located at the upper right corner of the screen and select the search icon located at the bottom panel. You can search for your preferred stock in the search bar by entering its symbol or code. Tap to select on the stock you wish to trade from the search results. Then tap on Trade to open the order pad. Select your preferred trading account. Enter your desired quantity and price. Select your order type: limit, stop limit, limit if touch. The validity period: day, FAK, FOK, GTD, GTM. Your preferred currency: SGD or traded market currency. And your payment type: cash, CUT, CPF, SRS. Tap on Buy or Sell. Enter the OTP verification code. Hit OK to proceed. Check your order details and click Submit Order. Your order is now placed. On desktop, search for your preferred stock in the search bar by entering its symbol or code. Right-click on the selected stock. Click on the Buy or Sell button to open up the order pad. Select your preferred trading account. Enter the quantity and price of your order. Select your order type. The validity, the settlement currency, and lastly, your payment type. Click Buy or Sell. Check your order details and click OK once it is confirmed. Complete the OTP verification to complete your order. You can check your order status by clicking on the order book icon and select Order Status from the drop-down menu. Click on the order you would like to check by right-clicking on the order and select Order Details. A pop-up window will appear with complete details of your selected order. Thank you for choosing CGS-CIMB. Welcome to CGS-CIMB, Asia's financial gateway. Here's how you can check your order status. On mobile, tap on the Menu tab and select Order Book. Tap on the order you would like to check to view your order details in full. You will be able to check the status of your order under Status. On desktop, head to the navigation bar. Click on Order Book. Select Order Status. Here, you can check your order details and order status under the Status column. Thank you for choosing CGS-CIMB.
Looking to access the U.S. market for all U.S.-listed stocks? Covering all U.S.-listed stock, Nasdaq Basic is the primary gateway for any firms accessing the U.S. equities market. We are helping and supporting any Asia-Pacific firms who need access to the U.S. market. With Nasdaq Basic, traders can access real-time U.S. equities quote and trade data cost-effectively and look at several key data elements for U.S. exchange-listed equities, including real-time best bid and offer, tick-by-tick price, and NASDAQ opening and closing prices, all at a fraction of the cost of consolidated alternatives. Nasdaq Basic is the leading exchange-provided alternative for real-time data coverage, includes NYSE, NASDAQ, and other U.S. exchanges, plus Nasdaq Basic can be implemented through a variety of investor tools, including watch lists, portfolio trackers, and dynamic tickers. To find out more, visit our website or email dataapac@nasdaq.com.
In our last video, we talked about the likely coming of higher inflation. Our themes in emerging markets were effective pandemic management, moderate inflation, exposure to commodities. And our preferred markets were China, Indonesia, and South Korea. But what stocks might fit those themes? Well, let's start with China. Strong economic recovery and controlled inflation should see continued improvement in Chinese banks' asset quality. And that should be one of the key drivers in the upward re-rating of Chinese banks. Our team's top pick here is China Merchant Bank, which is the country's second largest bank. We see double-digit earnings growth and rising ROE, driving a higher price-to-book valuation over coming years. Now, as we said in our last video, we also like real estate as an inflation hedge. A problem with Chinese property developers is policy risk, but investors may want to consider Hong Kong property developers which have lower policy risk. The Hong Kong economy is recovering thanks to its effective management of COVID-19. Meanwhile, limited new supply should enhance the sector's appeal as an inflation hedge. Our team's top pick here is Sun Hung Kai Properties, Hong Kong's largest developer. For Indonesia, our preferred commodity play is nickel, which rides on the renewable energy theme. And the two stocks with nickel exposures that investors might consider are Anika Tambang and Vale Indonesia. Other commodity plays that might gain ground on the commodity theme are Merdeka Copper Gold for copper and gold, and Medco Energy for oil and copper. South Korea, well, there we like semiconductors as a digital economy commodity, which like other commodities are also in short supply. For this, our sector analyst's top pick is SK Hynix. We also like shipbuilders for the inflation theme, on the expectation of rising new building prices for vessels, as Asian shipyards are generally running at pretty full order books. In that sector, our analyst's top pick is Korea, shipbuilding, and offshore enterprise.
Looking to access the U.S. market for all U.S. listed stocks? Covering all U.S. listed stock, Nasdaq Basic is the primary gateway for any firms accessing the U.S. equities market. We are helping and supporting any Asia-Pacific firms who need access to the U.S. market. With Nasdaq Basic, traders can access real-time U.S. equities quote and trade data cost-effectively and look at several key data elements for U.S. exchange-listed equities, including real-time best bid and offer, tick-by-tick price, and NASDAQ opening and closing prices, all at a fraction of the cost of consolidated alternatives. NASDAQ Basic is the leading exchange-provided alternative for real-time data coverage, includes NYSE, NASDAQ, and other U.S. exchanges, plus NASDAQ Basic can be implemented through a variety of investor tools, including watch lists, portfolio trackers, and dynamic tickers. To find out more, visit our website or email dataapac@nasdaq.com.
CGS-CIMB is a leading integrated financial service provider in Asia. Through our network of local offices in Malaysia, Indonesia, Singapore, Thailand, branches and strategic partners, we have a global presence in over 20 countries, providing a truly Asian perspective. Our businesses include retail broking, institutional equities, derivatives, prime services, equities research, wealth management, and online broking. We also offer a range of Islamic services, such as Islamic stockbroking window, Islamic cross-border trading, Islamic securities selling and buying negotiated transaction. Backed by an award-winning research team, we have one of the most comprehensive research coverage of over 800 stocks in the region. Our strong research capabilities form the backbone of our product and service offerings, connecting clients to opportunities. CGS-CIMB, your financial gateway to Asia.
Hi, good evening, everybody. Thank you for taking the time out to join us tonight on a very special presentation on the macroeconomy in the US and retail investors. I'm Tim Phillips, head of content for Prosperous, which is a digital-first investment service for millennials under the CGS-CIMB brand. If you're interested in ideas for long-term investing and for buying and holding, please go to prosperous.asia and check us out. Maybe open an account and just check out the content that we have there. So without further ado, I'll introduce you to our special speaker tonight, who is Phil Mackintosh, the chief economist at Nasdaq. Phil has got a wide breadth of experience with over 28 years in the financial industry, including roles on the sell side, the buy side, and at accounting firms as well. He's an expert in index construction and ETF trading. And prior to joining Nasdaq, he was a head of trading and strategy and analysis at KCG Virtue Financial. He's also served as the global head of trading strategy at Credit Suisse. He started his career at KPMG and is also a chartered accountant. So without further ado, I'll hand it over to Phil. Phil, take it away.
All right, thanks very much, Tim. And what I'm going to talk about today is a lot of what we've been researching the last sort of 12 to 18 months, and that's the US markets, how much trading we've seen, and how much of that trading is retail. So let's dive right into it. When you look at figures of retail trading in the US market, there's no clear way of defining what retail trading is, but there's a generally accepted belief that these sorts of numbers where retail trading has increased from about 10% of all market volumes to over 20% in the last couple of years are pretty close to accurate. And you can see the last 2 years, we've seen a dramatic increase in retail trading. And I guess if you're running a retail broker, you would have a confetti dropping right now. But that's one of the things that turns out potentially to be a little bit of a problem, as we'll find out. Sorry. The other thing that's worth highlighting is what's happened to overall volumes in the US market. So when we look at total volumes in the US market, we saw a bump to around about 10 billion per day in the credit crisis, and then things calmed down quite a lot. The last 2 years, again, we've seen record levels of volumes in 2020 and now again in 2021. And you remember on 2021, that's on lower volatility than we saw back in 2009 or in 2020. So it's really kind of unusual that we've seen growing volumes and falling volatility. But what I'm going to show is that those two trends are somewhat related and probably not in the ways that you would expect. Let's start by talking about the growth of retail trading in 2020. So when we think about retail trading, a lot of the retail trading in the US actually doesn't trade on exchange. It goes to market makers that we call wholesalers. And so you can see from the data that shows the growth in wholesalers between the early 2020 period and around about now, that the growth in those wholesaler market shares is almost doubled. And that's one thing that confirms that retail trading has increased. Another data point that we could use is looking at the daily average trades that are reported by some of the retail brokers. And so on the right-hand chart here, you can see a couple of things happening. Back in the end of 2019 in the US, we went to zero commissions for a lot of retail trades. And so you can actually see an uptick in retail trading as we went to zero trades. But we saw a much more dramatic uptick when we went to the COVID lockdowns in the US. And so that, to me, is another driver of the rail activity. And I think the data will show you that that's true. So let's talk about the data, the macro backdrop of the COVID shock. Like, why would that matter to retail? And I think the right place to start is two data points like this. So the chart on the left shows the number of small businesses that were shut down in that 2-week period of March when we went into lockdowns in the US. And so almost 50% of businesses had closed. And that meant that almost 50% of workers had no work to do, whether they'd lost their jobs or they were on unemployment benefits. There was a dramatic decrease in hours worked. There was a dramatic shutdown of businesses. And so what you saw from an economic perspective was pretty dramatic. We can see grocery stores, food and beverages spiked up more than 20% in the space of months. Those products also saw pretty significant inflation. There was supply chain problems caused by COVID, but also just caused by the fact that people weren't eating at restaurants anymore. They were eating from grocery stores. The flip side is all of the companies that were really, I guess, exposed to COVID in a negative way, things like restaurants and bars, clothing, and they saw dramatic drawdowns in activity for at least a couple of months. On the right-hand chart, the lines on the bottom here highlight some of the worst affected industries. And so airlines for a good 12 months struggled to get back up to 50% of their prior capacity, and cruise lines and movie theaters are still struggling to get customers to come to them at all for legal reasons and just for customer confidence reasons. And so you can kind of see there's a lot of businesses that were affected in different ways from coronavirus. In the short term, there was also some winners. And so we put this together a couple of months in, and we could see a lot of activity in single stocks in the Nasdaq 100. Zoom Video, which is a household name, all of a sudden saw its stock price rise significantly as everybody was doing work on Zoom. Moderna obviously came out with one of the vaccines, and so it was doing very well as well. But also companies like DocuSign and PayPal, which help us work remotely, NVIDIA and AMD, which make chips for all the video games and the video processing that we needed. Even some of the communications companies, obviously Amazon delivering products to everybody. There was a lot of companies that really benefited from the lockdown and the way that we changed the way we live. The flip side on the right-hand side here is there was a lot of companies that didn't as well. And so a lot of the bricks and mortar retail that in the States, a lot of these are brand names, disappeared very early on in the crisis. And so a lot of the bricks and mortar retail that couldn't turn themselves into online retail found this was one of those events that are shuttering businesses. What else is interesting is looking at what happened in ETF trading in the US. So we put together I guess a grid or a filter to try and find ETFs that were unusually active. And so what we found was we looked for ETFs that had unusual asset growth, unusual volume compared to their normal volume, unusual value traded, just high amounts of money being traded in them, or just price returns that were exceptional as well. And we scored all of that and we ranked it. And so what this is a couple of months in, what were the top ETFs that we had seen traded? And what's interesting is you can see up the top here, number 1 and number 3 is airline ETF. And so obviously as coronavirus kicked in and we saw that data on airline traffic falling, the JETS ETF is a red line with a negative return, but actually inflows. So people, although it was selling off, people were adding positions to it because they thought it was a good recovery play. And it turns out a little bit later that's true, and you could see quite a strong recovery trade with even more money flowing into that ETF. You saw a lot of flow in energy products, gasoline, because again, for the same reason, it had sold off dramatically. People did not need to fly, they didn't need to drive. And so there was a recovery trade that people did with some of these thematic products. But even more interesting, I think, are some of these recovery trades in cloud computing and online retail, leisure and entertainment. Some of those sectors we talked about being really beat up and really badly affected by coronavirus. You actually saw people buying those products at the bottoms and positioning for the recovery trade. And so ETFs have also been a pretty interesting place to watch retail trading. It turns out that the retail traders didn't do too badly. So this is some data early on. It's the first half of last year that shows the retail favorites that Goldman Sachs tracks was actually outperforming the broader market pretty significantly. And a lot of that outperformance continued actually. So the argument that retail traders would basically buy the peaks and sell the troughs and underperform does not seem to be what happened when you look at the results of their portfolio, their weighted portfolios. Of course, there was something else going on. The government didn't let coronavirus happen on its own. Initially, what you saw was a huge monetary stimulus. So on the horizontal axis here, it's comparing the monetary stimulus in blue to the financial crisis, Depression, World War II, to what we did in coronavirus. And these red dots you can see for all regions in the world are far to the right of the amount of monetary response that we saw for a lot of other pretty big events. They're also up higher than we saw for the global financial crisis, and that's the full stimulus. So we had this double barrel a sort of tackling of the problem where the monetary stimulus was very strong, and then the fiscal stimulus was very strong as well. And that's turning out to be really important now when people are talking about the inflation trade, but it's also important talking about retail trade. And so when we look at the US data, you actually see in this pink line on the bottom of the left-hand chart, when people stopped working in the office and when they were quarantining at home, there was a lot less to spend their money on. And so people actually spent less. They couldn't go to restaurants, they couldn't go on vacations, they couldn't go to sporting events. And so the spending actually dropped. At the same time, we just talked about the US sent out checks. They actually sent out 3 checks in the end, but you can see each time the checks went out, the fiscal stimulus went out, we actually increased the total household income. And so the gap between the two, basically net saving. And a different way to look at net saving, this is a global basis on the right-hand side, because all of the countries around the world basically did very similar things to tackle the problem. The net savings increased by about $3.5 trillion globally. In developed households. So really a huge amount of extra savings in the system ready to go once vaccines rolled out. And that I'll show you in a minute is important. But first, let's talk about how retail trade and how they traded early on in the coronavirus crisis. So this is another data point that we can access, just looking at the reported number of trades per account by a few different retail brokers in the US. And you can see on the left-hand side, most retail don't trade very often, about once a month, maybe a little more. Some brokers like Interactive have more active customers, but I think the general principle here is that most retail don't trade very often. Other thing we can see on the right-hand chart is that most retail trade very small amounts of dollars. So it's perfect to be able to compile this data, but this is a reasonably accurate way to do it that academics follow as well. And you can see that around about half of the trades are for $1,000 or less. Almost all of the trades are $1,000 or less. So retail trade infrequently and typically pretty small size. And that's important to remember. We can drill into that data that we were just looking at though, and we can actually work out ticker by ticker where we think retail is active. And this is interesting. So if we plot stock price on the horizontal, you'll notice that most of the higher price stocks on the right are yellow colored. That means there's not much retail in them. Whereas most of the stocks on the left are green and dark green colored, and that means there's quite a lot of retail participation in those tickers. When you look at this axis, it's also fairly true that the higher price stocks are the larger market cap stocks. So what you're seeing is not only like to trade low price stocks, trades for cap stocks. There's a few large cap stocks like Amazon and Tesla, Microsoft, Apple, Facebook, which are pretty green as well, but they're also brand name. And I think when you look at the green dots that are in the sort of scatter plot that are large cap, a lot of them are tickers of companies that Americans would know. And so that seems to be what drives retail trading. There's a lot of trading in micro names with a lot of growth potential and upside. There's also a lot of trading, retail trading in the names that you see every day. The pattern of retail trading in microcap extends outside of the listed companies. So this is actually a chart looking at what we call in America the pink sheet or bulletin board stocks, now called the OTC market stocks. These are not US listed, they're traded off exchange. As in completely off exchange. They're not even following exchange listing standards. And you can see that they're often very low price stocks as well, sometimes less than a cent. And the volumes that we're trading towards the end of last year spiked pretty significantly. And you started to see during the COVID crisis an increase in volume off exchange here as well in these OTC stocks, unlisted stocks that started to pick up towards the end of December, which obviously is an important time we'll come to in just a minute. The other interesting data point is looking at something like this. So this is looking at downloads of the Robinhood software. Robinhood is an online app-based broker-dealer in the US. So you can trade on your phone, and you can see that when the stimulus checks went out, basically there was an increase in downloads of the Robinhood software. So just another data point that seems to indicate the stimulus checks themselves were actually a big motivator towards trading in the US market. What's interesting, thinking about this, I guess, from a regulator's point of view, is because of the huge increase in activity, a lot of the systems were put under some pretty dramatic stresses. And so there was reports throughout the year, multiple different dates, of different broker-dealer systems, different retail systems having outages, just not being able to keep up with the new volumes of retail coming into the market. So it kind of highlights just how quickly things grew and how quickly the amount of activity in the system would double much more than people were expecting. And so if we look at it, we can actually see it wasn't just stocks, which was where we started, looking at the stocks in the last couple of years trading on the exchange. There's another way of looking at options, which is you can look at options trades that are less than 10 options contracts versus all the rest. So you see very small options trades, which are typically attributed to retail as well. And what we've seen is the very small options trades have also increased starting in 2019, but increased even more as the coronavirus crisis has settled in. And as we've seen more brokers signing up retail customers on their platforms. So putting all of this together, what's interesting is just to look at that top line growth number. So now we're looking at the top line growth in green of the equity market volumes, which is the left-hand axis, sort of trading well above 12 billion shares now. That's about $400 billion. The options market itself, which is the blue, is trading about 40 million contracts ADV, which is about 200 billion notional. But if we work out how much of that growth was retail, which we've done here in the lighter shaded colors, you can retail accounting for a pretty decent percentage of the growth that we've seen in the market, but not all of it. So the whole market itself has actually become even more active as we've gone through the coronavirus crisis and now as volatility is falling into 2021. So let's get to the interesting part. What's been happening in the last 6 months? Now, obviously, the US had an election in November. That turned out to be less important for markets than the COVID vaccination approvals. And so once we had vaccination, it started to change pretty quickly. But in reality, the US had already started to open up a lot of its markets. Production was actually very strong. And so what you saw was companies initially had started to draw down inventories as all of the stimulus checks led to new purchases of goods, because that was something you could do while you're still in lockdown. And rather than put on new staff and gear back up in the supply chain, the companies typically used up their inventories. And so you saw inventories getting to a very low level. You also then saw companies realizing that they would need to suddenly stock up on inventories, and so they started to purchase more to import, and that led to surprise pretty significant inflation on the input side of the producer prices. But still, we're talking all about the goods sector of the economy, and that's important because when you look at the goods sector in the US, it had a V-shaped recovery. It was back above coronavirus levels pretty quickly. And it stayed that way. And a lot of that is due to the stimulus checks. But what we didn't see was the similar recovery services, which is the higher line. And it's the higher line because it's a much bigger portion of the economy. So even though the goods sector was booming, the net employment was actually being held back by the lack of services demand, the lack of services employment, which tends to be lower paid jobs, but a lot more people. And so what you saw, if you look at the right-hand chart here, is that the GDP in the US bounced very quickly, pretty much a V-shaped recovery. Unemployment has not followed the same trajectory. And so the lag in payrolls, the lag in employment in the US is primarily because we haven't been able to demand services while we're in quarantine and while we're in lockdown. And that's why the vaccine is important, because now we have the vaccine. You can see the caseload in the US is dramatically reduced. Most states have taken away mask mandates. Most states have taken away rules about social distancing. And you can see in the activity levels now, sporting events are back on, travel is back on, the airlines are getting pretty close to pre-coronavirus levels, hotel demand is up. And so just from the spending pattern, you can start to see these service industries seeing extra demand now as well. And that's showing up in the jobs numbers. So if you look at the jobs postings, for a couple of months now, we've had more jobs than pre-coronavirus levels, a really strong employment market. And a lot of the places that that's coming through is in some of those really badly coronavirus affected sectors. airlines, department stores, hotels, restaurants. And so you're starting to see a lot of shortages of labor in those sectors. You're starting to see wages increase. The other thing that we are seeing, which is important for stock valuations, is the return in the market is positive, which you can see from the blue diamond here, has been for the last 3 years net. But the 2 years before, a lot of the return came from the PE multiple. So basically, as interest rates in the US went down, it justified higher valuations or higher price earnings multiples in stocks, which makes sense, right? If you're thinking about a discounted cash flow valuation and your discount rate goes down, the valuation of the company goes up. What that also means is for a growth company with more of its earnings into the future, the valuations go up even more. And so that explains the record spread between the growth outperformance of value as well that we've had in the US up until 21. It's still closed, but right now, because rates in the US are still very, very low, growth is still outperforming value. But what's important here is the performance of the market this year is coming from earnings. So a lot of companies are seeing an earnings recovery. And so that's really good for the companies. It's really good for confidence, but it's also descriptive of some of the trades that we saw people putting on during last year. And looking here, we see some of the really big factors. There was just no demand for flights, not much demand for driving early on. Financials, even industrials that underperformed before the vaccine are now some of the best performers post-vaccine. And so you've really seen that rotation trade as vaccines have come out, twist people's focus back into the sectors that were really badly affected by Corona and now have recovery trades aspects to them. But 2021 is being driven by something probably other than fundamentals in terms of the volume and activity levels. Some of you may have seen in the press what's happening in the US is a lot to do with social media and so-called meme stocks. So ironically, in January 6th, I'm pretty sure everybody knows we had the US Capitol riot. Then pretty quickly after everybody pivoted from the social media focus on politics, Reddit and a lot of social media activity focused on a small group of relatively small cap stocks. And you can see their prices here, more than quadrupling, some of them going over 1,000% in the space of just a few weeks. And what was amazing about that was the percentage of volume that these meme stocks made up peaked at around about a third of the ADV in the market. So remember, we just said the US market is trading about 12 billion shares a day. 30% of that was just a small group of these meme stocks that are relatively small cap companies. Because they're low priced, it wasn't that much of the market's value. It was only 8 or 9% of the market's value that it peaked. But you could see because they're low priced, they trade a lot of the shares. And so just to put things in perspective, back in January, GameStop was the most, active of the meme stocks. And so GameStop on a couple of days was trading well over $20 billion. And its market cap was around about $1 billion, even less at the start. So you can see the turnover of GameStop is just phenomenal. But more importantly, it was trading more value than Tesla or Apple or Microsoft or Amazon, which all trade around about $15 to $20 billion a day, every day, and obviously have market cap, if we look at the right-hand axis, that's over $1 trillion. So these meme stocks, very small stocks, were trading extremely actively. AMC, everyone's talking about now as well. And so what was happening was the social media was creating a lot of grouped trades, a lot of market impact. I mean, for me, having grown up on broker-dealer side, trying to build algorithms, you shouldn't have that much liquidity in a stock with very small ADV normally. If you do and you see market impact or price moves like what you saw, it looks like market impact. So it's probably not good prices to be executing at. But for individual investors, they were, I guess, less concerned or less aware that they might be, as a group, having the market impact. And so there was a lot of ways, not just about what was going on in Reddit and the social impact. Because of the amount of trading, it created settlement constraints. It created a huge amount of credit exposure at the clearers for some of the broker dealers. And so a lot of the systems, a lot of the brokers had to restrict some trading, which of course led to a few other social media comments about how could do that. Why did we see the meme trade? And I think in the beginning, what we were really seeing was a short squeeze. And so you look at the most shorted stocks back at the start of this year. You see GameStop, you can see a lot of these tickers that we've sort of highlighted with high turnover have short interest. It's well over 50% of the shares outstanding. That doesn't actually mean that the stock doesn't have that many long investors left, because of the way America works. You've got to borrow stock so that you can settle the short trade. And so you basically are selling to a new long investor, which means that the gross long interest is actually larger than 100%. And so having short interest this high doesn't really mean a systemic problem, but it was something that was targeted. And what it does is it creates a short squeeze where if you can make the price go up, then the shorts obviously lose money. And so the shorts themselves have to cover, which means buy, which makes the price go up, which makes your position profitable. So from a short squeeze perspective, it was pretty easy to see the impact of that on the demand, on the prices rising. What was interesting was just how quickly the shorts actually got out of the stock. So you can see that first data point that we just showed you in blue, within 2 weeks, almost all of these stocks had dramatically reduced their short interest back to 30%. Within a couple more weeks, they got down pretty close to 20% short. So almost all of the extreme shorts came out of the stocks very quickly. Of course, then the market seemed to pivot away from the meme stocks. And what's interesting is what happened in this period in between was that crypto had a pretty good rally. So you can see here, this window between the end of January and so the start of May was when crypto had a very good rally, and then it's to sell off to the prices it's basically been at recently. And that's interesting because once crypto started to fall, we actually saw a second wave of the meme stock trade. And so this chart on the left is looking at, you can see that the late January bubble in stocks like GameStop with its price rise. And on the right-hand side, you can see the volumes, so the share volumes in blue. Then you can see, start of June, another spike in prices and another spike in volumes. Less significant in terms of share volumes this time, but actually more impactful in terms of price, especially for AMC, which I guess some would argue might have some fundamental recovery trade aspect to it because that is a movie theater stock. And so people were at last unmasked and able to start going to movies. But the fundamentals of AMC probably don't stack up, which we'll talk about in a second. What we'll talk about first is just how this time, with less volume, they caused more market impact. And one of the things that did happen the first time round, but that you can see especially the second time round, is trading of options. So if we look at options contracts, we look at the options premium paid, the spike in volumes the second time round for these meme stocks was higher than the spike in options trading the first time round. And when you break it down, you can see on the left-hand chart here, it was a lot of calls and not so many puts in stocks like AMC. And so obviously when you buy a call, the market maker sells the call to you and has to go hedge. So they have to buy the underlying stock up to the delta hedge. But buying the stock, because it's a small cap stock, makes the price go up, which means that delta hedge has to increase. That's called gamma. And so you have to gamma hedge. And as you're buying your gamma hedge, of course, the price goes up even more, especially if other people are also buying alongside. And so you can have this a little bit like a short squeeze where the other participants in the market are buying alongside the naturals, especially as the hedge needs to keep increasing. And so the call buying itself can leverage other buying through the market. It's amazing. You look at the premium here that was being paid on AMC. It's more than for the S&P 500 options. It's more than for ETF options, for Google, for the Nasdaq 100 options. I mean, it really was a pretty phenomenal amount of focus on one ticker, which is a small cap ticker in the option market. And so that's why a lot of people started to talk about valuations in the US market. And AMC in particular, if you look at revenues on the horizontal axis here, and you look at market values on the vertical, this makes a lot of sense if you think about stocks long term. revenues really do support valuations. And that's basically what the diagonal nature of these dots show, is that as a company earns more, its market value goes up. And so AMC before all of this was roughly in line with the horizontal diagonal. Now its market cap is smaller. Partly that's because of the coronavirus, but its revenues are smaller, but its market cap is much higher because of the meme stock trading. So it could have a recovery, I guess, in terms of revenues to get it back out to 2019 levels, but that would still leave its market cap well elevated versus the diagonal line that we've got here. And I think some of the other fundamentals that people are talking to is, like we said, if you look at the right-hand chart here, movie box office is one of those things that was really slow to recover from coronavirus. People, even as vaccines started to roll out, people didn't really want to go and sit in a movie theater next to other people they didn't know. We saw similar things in China even early on, where their activity levels picked up pretty quickly after they came out of quarantines, but people still didn't want to get on public transport. They didn't want to sit on trains for hours at a time next to strangers, and they much prefer to drive. So we've seen very similar things around the world. People are coming back to restaurants, but a lot of restaurants have outdoor seating. People are flying again, but masks are required on flights. In movie theaters, it was still a bit of a struggle to get the revenue picture to catch up. So I guess that leaves us with what's next. And so it's left the regulators in an interesting position. I think normally after a huge amount of activity like this, you would basically see the regulators go off and look at the data and come back and write a big report, which we've seen multiple times before. And that's what they're doing. The regulators are definitely looking at a lot of different issues in their report. So we could see some pretty significant changes in the regulations. Even little things like us as an exchange can put stock halts out if we think that there's manipulative trading or a problem with the way a stock's trading and it's not trading fairly. What we did was we did a little research into what happens when stocks double in the space of a week. And what's amazing is that most of the time, basically, it happens pretty quickly. You can see, or it happens pretty frequently. You can see all of these deciles by color of stocks that doubled at least in the space of a week. And what happened in the next sort of 60 days is revealing. So for the most part, almost all of these green lines, which is 50% of the observations, pretty much held those 1 week gains. There's only one red line, which is 10% of the observations, where the market shot up and then within the space of 60 days was back even worse than the starting levels. And so what we found was a lot of the time the stock moves up because of news. And actually the news helps justify the future valuation. So basically you're seeing that markets are really quite efficient and quite good at price discovery, which makes it really hard as an exchange to put in place a rigorous rule that says, if a stock moves this far in 2 days, then halt it. Because a lot of the time that's actually genuine price discovery and genuine investor perception. So what regulators are looking at in the US is a range of potential changes. And I'll take you quickly through the regulatory platter that the SEC and a few other groups in the US are looking at. But if we start on the left, which is the gamification problem, and that's in the very first slide, we talked about the streamers and confetti. And so there is a perception that a lot of these retail apps have made it too much of a game to play on the stock market. And I think there's an important point there, because for us as an exchange, talking to issuers, trying to raise capital, the stock market's job is really to allocate capital efficiently. It's to find investors to buy into business propositions for growth. And we don't want to make the stock market too much of a game. The other aspect of that, of course, is investor protection. And we've seen this play out a few different times where the investor gets last, ends up losing a lot of money, and unnecessarily so. So the SEC is very focused on that. One of the things that's related, we talked about the fact that retail trading almost all trades off exchange in that second chart. And so because the way that happens is the wholesalers actually pay for order flow. So they write checks to the retail brokers in order to get exclusive looks at the retail flow. And there's a perception in the market, at least, that potentially that payment for order flow has helped contribute to free commissions, and the free commissions themselves lead to overtrading. They just take away that one friction that might stop retail investors from thinking about cost before they press the buy button and the sell button too quickly. A related problem is that when the order flow, the retail order flow comes into the wholesalers, they often price improve it at a price that's not a decimal. So in the US, every single other trader has to use limit orders that are decimals. And so by price improving, you basically ensure that the trades stay in your proprietary trading network and are filled at prices that are better than the market. So theoretically, you should get more flow. And so the regulators are also looking at what that does to the national best bid and offer. If you take away a whole chunk, whatever it is now, 20–24% of the market, and say that's not going to participate in the formation of the best bid and the offer, then maybe the best bid and the offer isn't as competitive as it should be. Related to that is just the fact that the off-exchange trading is increasing, and obviously there's profits attached to that, and there's quite significant profits that are being made off exchange with these retail orders. If we look at the top, I think what we'll find in the longer term is potentially, it'll be interesting to see whether the manipulation rules in the US actually cover what's gone on, but with the social media and some of the commentary on Reddit creating groupthink, it looks a lot like what in America we call a pump and dump scheme, where somebody hypes a stock or buys it, then hypes it, and then sells it for that they hyped it to. And that falls straight back down to its fundamental levels. And so that's a form of fraud. It's illegal if it's found to be what's happening here. And the regulators are probably trying to connect the dots between who is on the social media accounts and who's doing the trading to see if there's any actual legal activity. That is being helped by the fact that we now have the CAT, which is a consolidated audit trail, and that helps with surveillance. So in the past, the data for each separate market and all the separate broker dealers really wasn't aggregated up in a very consistent way. It made it very hard to look at what was happening on the Nasdaq and off exchange and connect that to a customer account. So the CAT is starting to make that surveillance, that cross-market surveillance, easier. We talked about putting in stock halts. It's not as easy as people think, and other sorts of guardrails. In reality, the US has already got short sell guardrails. It's got single stock limit down and limit up guardrails that have worked. They've stopped a lot of these meme stocks midday. They've restarted, and they've kept going with price discovery in an auction. So to a degree, the single stock guardrails that worked back in the coronavirus sell-off are still in place. The short sell rules that we've had in place throughout the last multiple years still exist, so you can't short sell without borrowing. But maybe some of the short sell rule disclosures could be looked at. And so in the US, short selling is basically a total number, like we looked at, that the 95% of GameStop that was short sold versus its market cap outstanding. There's very little known about who is the short seller, how big their positions are. Whereas on the flip side, on the long side, there's a lot known about which account owns the position on the long side. And so there's some talk about either increasing the frequency of short selling or at least making it more similar to how long disclosures work. There was a lot of discussion about trade fails and obviously broker margin, because remember, one of those slides we popped up showed that there was a huge amount of credit risk in the settlement system. Even with T+2 settlement, the $20 to $25 billion a day trading just in GameStop basically created a lot of credit risk and single stock risk. We had to margins in the settlement system to avoid fails. And so there's been discussion about going to T+1 settlement. And that would reduce, obviously, almost by half, not quite, the amount of exposure in a T+2 settlement environment. But it would make the US different to most of the rest of the world, which is kind of an interesting position to be in, especially for market makers that are trying to cross-border multi-country trades. So there's a lot going on in the US. Ironically, a lot of it was caused by what we've been talking about, the retail growth that we saw triggered well before coronavirus by the free commissions, boosted by all the stimulus checks that came out with coronavirus, boosted by the fact that people were sitting at home with much less to do, potentially with more savings because they hadn't been on vacations. And then you saw the activity sort of start to leak into lower priced names, riskier names, off like non-listed names into the option space, like retail starting to trade more risky stocks. Sort of got to 2021 and it's emerged into this meme stock trading phenomenon, which I'm sure is not what most retail are doing, but there's a subset of retail which is active enough that it's actually causing volumes in 2021 to exceed 2020, even as volatility has come down. And so there's a lot of things for the regulators to consider. I think it's kind of interesting just looking forward at where we might be going, because in reality, vaccines are being distributed in the US. Most of the states, like we mentioned, have masks off. And so potentially what's going to happen for the next 6 months is a return to normal. Those retail traders might have less free time. We might start to focus more on some of the post-COVID changes, like will commercial real estate ever recover? Will people work from home on a more permanent basis? Companies like Zoom hold their gains. And so maybe we'll see a return more to fundamentals and more towards larger cap stocks. We could also see interest rates rising as we see inflation coming through the system just caused by this huge amount of stimulus. We've seen the stimulus cause inflation in groceries. We've seen the stimulus start to cause inflation in the input prices for manufacturers, and we're now starting to see wages tick up in the services sector. So it really does look hard to avoid some inflation. The current rolling inflation number in the US is 5%, but a lot of that is because it's from 12 months ago when we had deflation from coronavirus. Whether it persists for longer and we have longer inflation could actually lead to a reversal in those interest rates that we were talking about. Higher interest rates probably means a headwind for stocks. So there's a lot of things going forward that might mean that the push that we've seen from retail in the last 12 to 18 months fades a little bit from the headlines, and actually the stock market itself starts to focus on fundamentals, valuations, and forward risks like the debt load, interest rates, and inflation. And so with that, I will stop.
That was a really informative presentation. A lot to take in there. I hope people enjoyed it. I think we've got a couple of questions. If you're happy to take some Q&A, we can get going. I think the first one's an interesting one. I mean, you kind of mentioned about how costs have come down and how people are trading, and I think young people have definitely taken a liking to the market with lockdowns and with all these meme stocks, as you said. But you've got this massive interest in the US market from, say London to Singapore to Sydney, just in the international investment community. Do you think they're going to play a bigger role in the makeup of the US market, international retail investors, just because of the size X the US? And do you think how do you think that's going to influence the market going forward? And I guess furthermore to that, do you think this sort of trading mentality will stick around post the whole COVID environment, and do you think it will become a permanent feature of the market?
Yeah, I mean, even in the US, we've seen that a lot of those new account openings were young people, like millennials and even younger, that hadn't previously really invested in the stock market. And for them, this is a great thing, because if you look at other investment choices, bonds, owning your own house, don't tend to actually secure your financial future as well as stocks and the dividends and the capital appreciations from stocks. So getting people a more balanced portfolio of their own is a good thing. I think getting retail into the single stock ownership, ETF ownership, and benefiting from that is a good thing. And you're right. I think the US market is attractive globally, partly because there's so many choices in it. We've got 6,000 listed companies. We've got 3,000 companies that are pretty large in size with a fair bit of liquidity, very cheap trading costs. You've got a lot of ETFs on the thematics. Because of the fact that it's such a big ecosystem, you can build a 20-stock thematic ETF basket that's diversified against a theme. It's very hard to do that in other countries just because there's not enough companies with the same currency and the same time zone for market makers to put them together. And so what you're saying makes total sense. For the international investor, the US market's attractive for a lot of reasons. It's very cheap for them to trade in, and the companies there, I think what's interesting is looking at the outperformance of the US market versus a lot of other countries in the world too. And it's been driven by a lot of the new economy stocks. So when we went through that list of single tickers that really benefited from the coronavirus lockdowns, companies like Zoom, companies like Nvidia, Amazons of the world are kind of US-centric companies. Like the tech sector, that growth and innovation sector really is much bigger in the US than in other regions.
Yeah, and I guess the US companies as well, like they're just global brands, aren't they? I guess like Zoom and DocuSigns, like they're products that everyone uses, and I guess millennials and sort of Gen Z are quite comfortable using as well, aren't they?
Yeah, and I think that's a really important point. I mean, just because it's an American listing doesn't mean it's got most of its revenue in America. I mean, a lot of companies in America make lots of revenue and sell lots of product globally.
Yeah.
To the point that you don't really see the FX moves have such big impacts in a lot of the companies either.
Yeah.
They're naturally hedged.
Thanks. Okay, I think we've got one more. So, I mean, what do you think's behind the rise of the retail investor? Obviously, you've got that, the meme stop and the lockdowns, but is there anything else out there that's kind of speaking to people to kind of come trade? And do you think there's a preference in terms of the sector or type of patterns of stocks? I mean, obviously outside the typical meme or tech stocks, is there anything else that you're noticing with the rise of retail investing generally?
Yeah, so I think the fact that things have automated in the last 20 odd years has really helped drive this retail trend. You can trade it on your phone these days. And I think that's really important because it just makes the stock market so much more accessible. In the old days, you would have had to have a broker and phone them up, and then they would have phoned the floor, and the floor would have done the trade, and spreads would have been more expensive. Automation has done incredible things to make it easier and cheaper to trade retail. The fact that we've gone to zero commissions now is, just like another step in that evolution. And so the frictions for trading in retail in the US are really quite low. And you can hold the assets, you can receive the dividends yourself. There's really not much work to do. The brokers themselves service the retail customers very well. So I think from that perspective, just opening up and democratizing the market is important. It's really interesting to compare how that's changed in equities versus how it hasn't changed in the bond market. And so treasuries in the US are still very much owned by institutional investors. The only place that retail investors exist in the bond market is muni bonds, which is in the US, if your state does a project where they need to borrow money, then that state will give you a tax break on that interest. And so if I'm a New York State resident, I get New York State tax advantage from buying New York State muni bonds. That puts retail into those bonds, but they tend to buy them and hold them for a long period of time. They don't trade actively at all. There's not a lot of liquidity. The spreads can be quite wide, and the settlement costs can be quite wide as well. So I just think the fact that equity markets themselves are exchange listed, public prices, quotes that are bid and offer tight spreads all the time just makes it so much safer and easier for investors to put liquidity in and pull liquidity out and earn the money in between. So I think there's a lot to be said for automation, but also for transparency. It just makes the market work really well for any investor. Yeah,
it sounds like equity markets have definitely sort of benefited in terms of technology way more than bond markets have, or they've definitely taken advantage of that much more than the bond market has anyway in general. Okay, thanks, Phil. I think we're kind of at the end of the presentation for now. So thank you for your time. It was a really interesting presentation. I think before we go, I'd just like to share with everybody here, not to forget to register for our Driven campaign and start trading with us to stand a chance to drive home a Tesla Model 3. Who doesn't like a Tesla, as well as Apple products. And if you do have time, also register for our next upcoming webinar, which will be featuring, I think, in the first half of July. So please do register for that as well. Okay, I think that's it for tonight. Thank you, and we hope to catch you again soon, Phil. Very, very interesting presentation. Thanks for your time.
Thanks for having me.
Yeah, thanks a lot, Phil. Thank you. Bye, everybody.